Yep, that is fine. So if you want, when you want to talk without the PowerPoint up, or you can just talk over your PowerPoint, just hit the green share at the bottom and share your screen, and you can talk and they'll be able to see you up at the top.
Okay, wait a minute. Where's the share?
Down at the bottom is a little green.
Oh, I see. Okay, wait a minute. I'm catching on. Sorry, guys.
No worries.
There's my, so can you see my screen?
No, not right now. I cannot.
Okay, wait a minute. Hang on a minute. All right. Share screen. Desktop. How's that?
No, it's not pulling up. If
how's that?
The green with the arrow still just showing us.
How's that?
There we go. Now, just if you hit play on your slideshow, it should go because we see your whole desktop, not just the slide.
Yeah, you see all my pictures and everything. Okay, got it.
You're
okay. Thanks, everybody. And thanks, Brandon. Okay, you can go away now and do whatever you need to do.
All right, it's all yours. Take it away.
All right. Thanks, everybody. It's such an honor to be here. I know a lot of you, those that I don't know. I hope that we get to know each other. It's an amazing thing that Dan and Brandon and Danny have done here to put this together. But you know, it's an extraordinary thing. This entire multifamily world is an amazing gift that's been given to me, and that what we try to do is give it freely back. And so you're amongst like-minded people, and it's just so wonderful to share with you guys about. I'll tell you a little bit about my first deal, and all the things that I maybe did wrong. Not maybe, I did do wrong, and how, you know, hopefully it'll help your first deals go better, faster, further. And that's the whole idea, is to accelerate and to help each other and help the rising tide, you know, lift all the boats, if you will. So wherever you are now, I just got back from the beach, and I really like the beach. It's a wonderful thing. And you know, so wherever you are now, I want you to get where you want to go. And the biggest thing that I'm going to talk about today, if I can get this thing to change. Well, shoot, how do I do? Okay, here you go. The biggest thing that happened to me was a mind shift. So, you see, I thought it was about an investment opportunity, and it is. I thought it, but it's really about understanding what I have to bring to the party. And even if you don't think that you have anything to bring to the party, you do. And I'm going to help you kind of brainstorm and get that a little bit more solidified. And it's an attitude, and it's an attitude of service. You see, we're in an extraordinary situation here, is that we know something. We know something about a club that only the uber wealthy have known about before. I know a lot of wealthy people. I've had a nice little bumbled around career in advertising here in New York. I know I tell everybody, you know, I look 30, but I'm really 58 years old. And so I had this career in advertising, and I knew a lot of people that made a lot of money. And so I know a lot of high net worth people, and I'm amazed at the people that don't know about this, like hardly anybody. And the people that think it's a scam, it's too good to be true. It is just an amazing thing, because the ultra wealthy have been investing like this forever. Only I didn't know about it. And then, you know, there's a basis of knowledge. There's a basics of knowledge that you have to have about a deal, right? But you know something, what I found is it's less, you've got to know what you're talking about. You have to understand the advantages of this type of investment. And you have to understand but mostly it's about giving. This is about an attitude of giving. And when you get your head right, when I got my head right, and I had to have help to do this. I got a coach. Coach Trevor is going to talk tomorrow, and I think he's going to talk tomorrow. Coach Trevor McGregor, and he helped me tremendously. And so I'm going to talk about these three things and what I mean by those three things. To take a step back, you all heard Joe Fairless this morning, and he's an old friend of mine, and I knew him before he was famous. And I could tell you stories, but you have to buy me dinner or drinks to do that. But I'll tell you, he gave me a gift that I didn't know he was doing. I thought I was helping him. He's ended up helping me. So, and that's how this thing goes. So, just to get our heads right, that's kind of the mindset of what I'm going to talk about today, and it's the mindset of most of the people that I try to surround myself with today. So let's see. So you have more tools as far as the essentials here. What happened to me is that Joe called me. I'd invested in one of his deals, and I knew I'd learned about this or whatever. And he called me one day and he said, "Hey, you know a lot of rich people. Can you help me raise some money?" And I was like, "Sure, no problem." And I thought it was going to be super easy. I thought that I would just make some phone calls and everybody would invest and it would be no big deal. I called a couple of people that I knew just had boatloads of money, and they're like, "Holly, we love you. We'll buy advertising from you, but we're not going to buy, what is this real estate thing?" And they had been involved in a land deal somewhere, or they had heard somebody do something, and they were afraid. And so I was focusing on the deal and not focusing on the opportunity, and because I didn't realize it. Right? I didn't realize it at that point myself. And so, you have more tools than you probably realize, but you need to realize that you're operating, when you talk to investors for the first time, not only are you new, they're new too. And so you have to make it as simple as possible. And it's taken me 5 or 6 years to really, perfect that simplicity, and it's still not perfected, right? But, I guess the first thing that many of you have, so you got to figure out what tools you have, right? And just to get you started thinking about some of these tools that you have, you have business experience, a lot of you. Not everybody's going to have everything that I'm going to talk about, but at least for me, I had some business experience. Well, at the end of the day, this is executing a business plan. Multifamily investments, large apartment complexes. This is about executing on a business plan. So when I raise money, I talk about that. And I talk about the people that I'm associated with. I talk about Dan Hanford and how he's had success in business. I talk about Brandon and how he's had success in business, how many houses he's flipped, how he understands construction, how he's able to go save money. I mean, all of the things that I talk about Danny Randazzo, and if I'm working with these guys, which I do, I work with them a lot. I talk about his experience at Deloitte and how successful he's been in business. And then I talk about myself, and I'm no slouch either. And I talk about Joe Fairless and his success in advertising. So there's a lot of things that you have if you've got business experience, and don't discount that, because they're investing in you, right? Many of you have real estate investing experience. Now, many times during a commercial loan, when you're doing a commercial deal, the bank doesn't necessarily care, but I guarantee you that the people that you're investing with care. And they want to know that you understand the real estate space. They want to know that you've had some experience. Even the fact that I lived in garden-style apartments when I went to school in Texas, and after I graduated from school, my first job in advertising, I worked in Dallas. I lived in an apartment complex just like the ones that we buy. So all of those things, to be able to personalize it, because again, they're investing with me, right? All of the volunteer activities and clubs, and this is where you meet people too. So Joe will tell you about junior achievement. I've gotten investors from a swim club. My daughter's a swimmer, and we go to these swim meets, and I'll sit next to people and what do you do? What do you do? You know, we're there for a long time during the day. You know, I've got investors from our little pool and tennis place that we go to in upstate New York. So the more volunteer activities you can participate in, the more clubs. I mean, this is all about, you know, building rapport with people and just really putting yourself out there and letting people know what you're doing and asking a lot of questions about what they want. What they're looking for in investment, in an investment, right? You've all got family, and that's typically where this thing starts. My first investor was my cousin, and he invested in the first deal that I helped Joe raise money for back in the day. And I just actually got back from spending 3 days with him and his family, you know, and we were at a pool, of course, and one of their friends was at the pool, and we started talking. This is my cousin from New York, blah, blah. And then, hey, you know what? We invested in, she does these apartment complexes, and the friend's family, husband is a dentist, and we got to talking, and then the dentist showed up, and then we got to talking some more. And, you know, he wants to invest, they want to invest in this next project that I've got going on, working with Dan and Brandon. So, you know, everybody, all these people have friends, and then they have friends. So the business associates, a lot of the ones I called in for the first deal, when I didn't really have my head on right, if you will, they're calling now to ask me what it is that I'm doing. So, and then obviously all of their friends, families, and associates. So you have within you have to find your story. Every one of you, if you've been on the planet, and especially if you're here, no matter how young, how old, you've got a story, and there's a reason you're here. And there's a reason that this intrigues you. There's a reason that you want to do this, and you've got some past experience, and you've really got to dig deep and figure out what it is, what makes up your story, and why this is important to you, and understand that the tools and the assets that you have at your disposal that will help you. This group is one of those as well. And just about anybody, I think, here at this conference would be more than willing to talk to you about and help you. It really took an outside person for me to. So coaching has dramatically accelerated my progress, and I can't stress that enough. So it's really an attitude of service. And let me tell you why what resonates with me about this investment and the verbiage that I use when I talk about this. So I have to go into a conversation with a potential investor as this is your lucky day. I'm going to, share with you some things that are going to blow your mind. And there's this thing called Fidelity that you can buy stocks, and you can do this, and you can invest in a REIT. You can invest in all of these public options. And that's what Wall Street wants us to do because they all make money off of these public options. But what we're doing is a private investment. And we're going in and we're buying an apartment complex. So the government, Brandon just talked about the government and all of the things that the government incentivizes us. Damien just made a great presentation right before me. You should replay it if you weren't there, because he was talking about how there are tax incentives to do things that the government wants us to do. And the government wants us to invest in real estate. So there are many advantages. So a lot of people understand those advantages of investing in real estate, but they don't know that you can do it passively. But the uber wealthy in this country do. And so this is what I make sure that people understand. First and foremost is that Wall Street REITs, hedge funds, they all do this. You can invest publicly in these things, and it's a mutual fund that invests in real estate. What we do is we actually bypass Wall Street, and we go in and we buy an apartment complex together, and you actually own real estate, and you're able to get those benefits of real estate, of buying an actual real estate without the hassle. So I never thought about it. I lived in them. If you ask people in these apartment complexes that we buy, if you ask them who owns this, they'll tell you that it's the management company. They'll tell you the name of the management company that they work for. They don't even know who owns these things because they're owned by hedge funds, REITs, wealthy families, and this is what the elite have been doing. This is a club, and you are giving as a general partner, as a co-syndicator of one of these investment opportunities. You're giving your friends, your family, your business associates an opportunity to own real estate alongside of all the uber wealthy people, right? So it's an awesome responsibility. And the people that you work with, I can't stress this enough, it's all about the like-mindedness, and it's all about making sure that the team you're working with, that they've got the investors' interests at heart above every single thing, and they will crawl through broken glass to make sure that people don't lose money. And so it's not, the other thing that I try to do is really make sure that my head is right before I talk to an investor, because it's about enabling these two overlooked populations. I used to think that we were helping working Americans, right? So we go in and we buy these Class B apartment complexes that working Americans live in. So these are the security guards, they're the LVNs at the hospital, they're the people that, nobody's building new inventory for. They're all, all the new construction's Class A stuff. And just checking time here. And so this is an overlooked population, the people that are actually working in this country, right? But I also think that another overlooked market segment are those people that are worth, those accredited investors that are worth like $1 million to $5 million, maybe even up to 10. Like, the people that can't afford a Goldman Sachs asset management account or whatever. Warren Buffett talks about that, but he's not going and logging into his Fidelity account and buying stocks. That's not what he's doing, right? He's going in and getting insider stuff. And that's really what you're offering. You're offering people an opportunity to be in the club and to bypass, we're not buying a bunch of really tall buildings, right, in Manhattan like the one I'm sitting in, right? We're actually sharing the wealth. So you're also dealing when you're talking to people, we're all a product of our environment. And my environment was that my 10% dollar cost averaging in the stock market and all of that over time is good. And three things happened to me at the same time that got me into this, that made me as passionate about it as I am. Number one, I watched my parents die in 2010 and 2011. And they did everything right, just like they taught me to do everything right. You get the financial advisor, you do what they say to do, blah, blah. But see, here's the thing. In 2008, the stock market tanked. And I don't care how safe your investments were, if you were in the market, if you had to get money out to live on, which is what you have to do. You can't live on the 10% that they tell you about, right? You really have to withdraw, and the government makes you withdraw it anyway. But anyway, so if you have to take money out of that stock market to live on, you're hosed if it's down. If it's up, it's your lucky day. But if it's down, you're hosed. And so, but see, we're taught that that's all that we know. And that's all the financial advisors know. I don't think they come to work going, I'm going to not tell everybody something. I just don't think they know either. So I don't see a lot of people typing, but if you guys, if you want me to slow down, or if you want to know anything, or if you want me to holler and wake you up, just let me know, okay? Because I can see this little box down here where people are saying. So you need a foundation, though. You can't just talk about, again, you got to believe in. You have to know why you're doing what you're doing, and you have to know the advantages of what it is. But at the end, you still have to know what you're talking about. So, I'm biased, but I really like Joe Fairless's book. I mean, he's going to give you in that book a foundation of what you need to know. He's going to explain the basic structure of syndications. There's lots of different resources. Most of them are right here. If you sit here right here all day and you ask questions and you take advantage of the resources that are right here over the next day or two, you could probably learn the facts of how syndications are put together. And that you really have to know it. You really have to know the terminology. You really have to know how all this stuff is how a syndication is put together. But you don't have to know all of it. Investors ask me things every day that I don't know. And the whole idea is to not bullshit. If you don't know, you don't know, and you say, I'll find out. That's a great question. And so we find out. And the other thing that you need to know is how we mitigate risk, how things are underwritten, what the loan structures are, all of those things. And again, you can learn all of that. But it's important before you start talking to investors that you realize you don't have to know everything, but you need to know some basic stuff. If you don't know what an IRR is, then you really need to get informed before you start talking to investors or the GP-LP split and what all that means. You need to know that. So the other thing that makes this such a great investment, right, is just the fact that small improvements can add millions of dollars to the asset value, and commercial real estate is valued. This is not like you go buy a house and, when you go buy a house, you get the realtor to send you around and look at 5 houses and you make offers on 3 and by Monday you have a house, right? This doesn't work this way. So commercial real estate is all about the net operating income, and it's about relationships in the market. We're able to buy most of the time we can get these things because of the relationships that people like Brandon have. We can get these things, before they go on the market, and that's good for investors and good for everybody. So then we make little small improvements that add lots of value. If people will pay $100 more for a parking spot in Texas, and you've got a 500-unit apartment complex, and half of them decide to take the reserved parking spot after you've built the carport, that's a lot of money to the bottom line and a lot of value that you've created to the asset. And so that is in a nutshell why it's such an amazing investment. And then the other thing that I get into it depending on the situation. Keep more is all, to me, I live in this tax hell, and I was in a spot where most of my investors are, where I was making a good living, but I was paying half of everything that I made in taxes. I was paying 50 cents on the dollar for taxes, and I was watching it go poof. I was sending my daughter to private school because you can't send her to the public schools here. I mean, it's just really, really raping and pillaging the land, I really feel like. So when I discovered the tax benefits of this thing, when it really sunk into me, and when I went, I have a husband that thinks everything's a scam, right? And when he really, honestly, I had to take him to 3 CPAs before he believed me that this was even legal, and he even calls me Bernie Madoff to this day, right? It's such an amazing investment because if you're in a high tax area, the passive losses can offset this income, and you can really defer taxes for a very, very long time, if not forever. So there are lots of ways that you can do this. So I encourage, when potential investors tell me that they want to talk to their financial advisor, I tell them, well, then they're gonna tell you to run away from this. I've never, ever had a financial advisor at Fidelity or Merrill Lynch that has told potential investors to do this. If they tell me that they're going to talk to their CPA, I said, knock it out, baby, go. Because I have yet to find a CPA that doesn't have his own or his or her own investment offerings, right, that they're trying to sell. I have yet to have a CPA look at one of our deals and tell them to not do it. What they'll do is they'll say, this is great. If you know the people, if you trust the people, and if there's no reason why you shouldn't do this, unless your tax situation is a completely different thing that I've never met anybody. So just know that. The minute they say financial advisor, just tell them you'll save them all the trouble and go on to the next person, basically. Because if they're listening to their financial advisor, whatever. And then you have to know, as far as the basic, make sure to mention that in order to defer losses, you need passive gains. That's correct. So I'm not a tax person. There are plenty of tax people here you can talk to, but what happens in most of these deals that I involve myself with, there are distributions, and there's income from the property from pretty much the beginning or soon thereafter. And what happens is that because of depreciation, because of expenses, because of all of these things, typically there is a passive loss at the end of the year. So for a $100,000 investment, I may have $8,000 in my pocket from distributions, but at the end of the year, I may get my K1, and it might say that I lost $40,000 on paper. It's not unheard of at all, $40,000, $50,000 even, especially with the new tax law. So on paper, I've lost money, but I have money in my pocket. And you can't do that. There's nowhere else that I know that you can do this. So eventually you're going to have to pay it, but that's a whole other conversation that we can talk, because there are other things you can do there too. So, but you have to understand this. And if you get too far deep into it at first, depending on the person, it's going to scare them away, because they're going to think that it's like, I made a mistake. Once I discovered this tax thing, I was like, holy mother of God. I mean, this is just amazing. And so I kept talking about deferring this and offsetting that. And they thought I was like, this has got to be a scam. So I've backed off about that. But you should know it. You should know, because the conversation will, depending on who you're talking to, it may go that way. Then the team and how it functions. You need to understand the roles that people play and what the underwriter, what everybody does that's on the general partnership side, because investors are going to ask who's running this, who's making the decisions, and what's involved in this, and why are you getting that acquisition fee? They'll look at fees and they'll look at, well, wait a minute, what's this acquisition fee for? And well, it's about the fact that we have to underwrite 50 of these things to find one, and then you have to, I mean, there's a lot involved with winning the deal, if you will, and there's a lot of expenses involved. And so that's what that's about. And so you have to understand all of the numbers. You don't have to know them intimately. You really don't. You should. You're going to learn it as you go along, but you need to understand the basic structure and what makes this makes it all work, right? What goes into one of these deals. Then this kind of goes back to about getting your head straight. What's your focus? I talk a lot about finding my lane, because I didn't find my lane until I was really, my lane was always what my financial advisor told me to do. And that's what a lot of people's lane is. Most of my friends and family, and these are very smart, intelligent people, they've got careers, they don't have time to really, they think that diversification is different stock buckets. So, equity funds and international, and I've got the mix of this. But, what we invest for, and the type of investor that I want to be is really cash flow. Cash flow with all kinds of things in place to mitigate risks, because I do not want to lose money. That's first and foremost. I don't want to lose money, and then I want to make income, because I was able to, through all of this, through 5 years of investing passively, I was able to leave my career in advertising last year. Because you see, if you're making, for every $100,000 you make that's tax deferred, that's a $200,000 income in New York City. So once because again, I was paying 50% of what I earned in taxes. So that's the type of investor that Holly Williams wants to be, right? I know some super wonderful, smart people. A couple of them are speaking today. I mean, they know student housing, for instance. I mean, they know it backwards and forwards, and they're making money and they're doing great. It's just not what I know. And if I were younger or whatever, I might know it. Or if maybe I don't understand, I'm sure I don't understand. And but my lane is really very, very, very specific. Class B apartment complexes, that are cash flowing, that are already stabilized, that have a longer term debt on them, so that we don't have to get out at the wrong time. And that's really the type of investor that I want to be. But that doesn't mean that that's the only option out there. But you really need to know what your lane is, and you really need to stay in it. And it's killed me sometimes, because there's people that I really think highly of that I would love to work with, that just what they're showing me is not in my lane, and I just can't do it right now. Not right now. So, it's hard to invest for cash flow and appreciation. I've real estate in New York. I've bought a Manhattan apartment. I have a 4-family house in Brooklyn. It's appreciated like crazy. I've made more money in New York City probably than I've made anywhere else. But there's a lot of forces at work here that I don't have control over. And what I love about the lane that I'm in is that we really do have control over it. We can force appreciation by making small improvements, and we're not going to get rich quick. We're going to get rich slowly. So true value add, means that forced appreciation. You're not depending on the marketplace. High risk or low risk, I'm all about low risk. Wealth creation or capital preservation. It's hard to do both quickly, right? So it's important that the team you work with and that your investors are all in that same lane. It's interesting. When I tell people this is a get rich slow thing, they're like, well, wait a minute. They see success, but they don't see what went on before the success. I don't think I'm talking out of school. Joe will give me a hard time if I am, but he worked a long time, many years staying at flea bag hotels before he, was able to enjoy the fruits of his labor. And he still works harder than anybody I've ever met. And so, it's important to know that it's the thought leadership platform that a lot of people will talk about over the next day or two. I remember the first investors I talked to, they're like, Holly, I'll buy advertising from you, but what do you know about real estate besides the fact that you've bought a couple of houses and stuff? I mean, what do you know about large apartment complexes besides the fact that you've lived in them? So I didn't quite know what to say to that. I didn't know what to say, but this is a business. I know about business, right? I wasn't confident enough to say those things because I hadn't taken inventory of the assets that I had. Right? I was just selling. I was just going and saying, hey, this is a great investment. So it's all of this working together is kind of what makes it all tick, right? And when I then started telling my story, then it's gotten easier and easier and easier to raise money. But I will tell you that I haven't met anyone that has gone into this and found it to be a cakewalk, money just flows in, and it still doesn't, right? And even when it does, you have to understand what a huge responsibility that is, and it could all go away if you get out of your lane, right? And so it's easy. I spent many years. Remember, I started doing this in the beginning, 5 or 6 years ago, and I spent many years, toying with the idea that I wanted to do this, and I had to really get over a lot of stuff that was in my head. I really did. The day I quit my job last year, I was still afraid, and so if you're not afraid, that's probably not a good thing. And so, I do a little coaching now. I've got some people that have asked me to help them get going. And this is from a real email that I got about a couple of months ago about, hey, here, look at this. I found this. Look at this, and look at this. And we could do a condo conversion, and then we could go to it's near a college. So we could just sell them to parents and do student rentals and then creative finance. Oh my God. And so she's all over the place. And that's kind of how I was. It was really easy. So it's you got to do the work up front to decide what it is. You cannot do everything. This is a big world of real estate investing. And so if you're all over the place, investors don't want to invest with people that are all over the place. They want to invest with people who are confident, who are working with people who have done this before and that they know and trust, that, right? Because I could say, I'm working with Brandon Abbott and he did blah, 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 blah. And, I can say that confidently and I believe it myself. And it also helps if I'm investing in it at the same time, which is, and if I'm not investing in it, at least I can have somebody else that I'm working with that they're investing in it, right? Somebody on the GP side needs to have some skin in the game. If it's just a bunch of people that are not, that are just raising money and no one in the group is putting their own money in the deal, that's probably not a good thing either. So it's very, very easy and it's human it's human nature to be all over the place. And I'm really all over the place. And I know that about myself. And it's super important for me to stay in my lane. Right. So, I guess just how can you get started? Obviously you're in the right place. I would buy Joe Fairless's book without hesitation. I'm going to a Bigger Pockets meetup in New York tonight. So 6:45, that's where I'll be right after this. I listen to podcasts on the train and on the subway in to my office this morning. If you can invest passively in a deal or two, that you should do it. There's no better way to learn about it than to actually do it, because you can talk then to investors of how this is what it's done for me. You can partner with someone who can. I mean, when I first started out, people that I've mentioned before, that spent a long time in flea bag hotels. I mean, I partnered and I invested, right? So we were partners, right? So there are always people that will help you, but you have to know what to ask. Never be the smartest person in the room. I mean, I'm just bumbling around like everybody else, but I've really found some things that have worked for me. And so I urge you to, get some help, free or paid, and get going on it. Feel free to reach out to me. You can do this. It's not rocket science, and it's so important because we're really making the world a better place. So we have 15 minutes remaining. Brandon just gave me the hook. So talk to me. Who's got questions?
Oh, no hook, Holly. I just wanted to give you time.
It's all right.
You're doing great. Doing great. No, congratulations to being our highest attended room so far today. So
get out of here. Come on. We paid them all to come here.
No, it's great. And we have a lot of good questions. So I'm going to start going through these. And so the first question says, while personal relationships and knowledge is key, are there some suggestions on utilizing online channels or digital media to grow your base of prospects and your expertise and knowledge, whether podcasts, webinars, newsletters, Facebook, Instagram, or meetups? And I think you just kind of went over that.
All of those things.
All of the above. So being on this, learning about it here at the summit, going to meetups, being on Bigger Pockets, joining informed discussions, reading books, just constant education.
And different people have different roles in our lives, right? I'm married to a guy who I love dearly, but he's such a downer. I mean, he's just like, I don't get positive reinforcement from him. I get it other places, and that's okay. Because I can spend all day with people like you guys. And so, and he's a great guy, but I don't talk to him about this because he's going to go, it's a scam.
Yeah, I understand. Well, you talked a lot about financial advisors, and that's been a topic of discussion. I was like, if we could start our own financial advisor firm and, it's like they listen to whatever they tell them. I had someone, I'd mentioned in the last one, a relative, they were like, I found this great money market account that's paying 2.5%, returns. And it's just low risk. It's low risk. I was like, yeah, it's actually the highest risk possible because you're guaranteed to lose money because you are losing money right now. And but just getting people to think outside the box and the strategy behind that.
You're dealing with decades and decades and big advertising budgets, I know, because I was in it, that are against this. And red flags go up all over the place.
Oh, yeah. Well, let me get to the second question. Knowing what you know now, what specifically would you do different in your first deal? Why I'm asking is I just left my corporate job to pursue real estate syndication full-time. I have my first signed LOI and would love to know how to better mitigate risk on this deal and my next one. Well, that's a loaded question.
That is a loaded question. The first thing that I would do is I would talk to some of the people, Brandon, that are speaking here today. Is Danny Randazzo speaking today?
He's in room 3 right now. Yeah, he's.
Am I against him? Did I get more people than him?
Oh yeah, yeah. You
Oh
beat
yeah,
Dan.
he's
You beat Dan.
don't listen to Danny Randazzo. But no, there are people. Remember, I talked about underwriting. There are people that can absolutely talk about mitigating risk that you need to know how to do that when you underwrite, right? And you should ask those questions. So it is a loaded question. What was the other part of it?
Well, I think to touch on that, we're talking about, you mentioned staying in your lane or finding your lane.
Right.
Mitigating risk is knowing what your lane is and not thinking that you can cover all the lanes, because that's like Danny, Dan, and myself. That's why we work so well together. Because
Correct.
I know Danny's strong point is underwriting, and I don't try to get involved in that. So if you want to mitigate risk, make sure you have somebody that thoroughly understands underwriting and is not going to make huge, because you can make mistakes in underwriting.
You can make huge mistakes.
Underwriting, say whatever you want it to, quite frankly. But it needs to be verifiable, and it needs to be a proven model to be able to make it accurate. And so I think underwriting is one of the key issues to mitigate risk.
And you need to ask them, right?
Yeah, and partner with people that have experience.
Yeah, and so it's because you need to be able to tell investors that, and you need to feel good about it yourself.
Oh yeah, definitely. We got one other, actually we have more, but here's another question. Would love to hear you talk about preferred returns, the waterfall, et cetera, and how this pays out to respective parties when you sell. I know that this is something that it's hard for people to understand, the preferred return and then the catch-up waterfall, and what that means with the GP split, however you break down your Class A, Class B shares. So just, if you want to give a brief.
Real brief.
Of that.
But basically, it's cash flow during the hold period. All of that is accumulated, right? And then when you liquidate the asset, you get a check, and it all ends up all adding up to a cash-on-cash return at the end of the day, based upon the amount that you put in, and the IRR takes into account the time value of that money. So you can compare investments of 5-year hold periods versus 6-month hold periods or whatever, and all of that adds up. And what I look for is close to a two equity multiple. So at the end of the day, I want to be able to double my investment in 5 years.
Yeah, and one thing that I think people don't understand is the reason for a preferred return is that we're putting the investor first and saying that we will not split returns unless we at least achieve our minimum of whatever your preferred return. A lot of times it's a preferred return, but at the end, when you get the proceeds from the sale of the property or the exit, that's where the catch-up occurs. Or we understand that there's a stabilization period that it's going to take a while for that property maybe to start hitting your 15% returns. But in the meantime, we're not going to get anything as the GP partner until we achieve our pro forma that we told you we would. And so we're going to make sure you get the returns at first, and we'll catch up later. And that is a good way to align with investors. But I know that some investors see that in the reverse. They're like, oh, you're going to get your 2% anyway, so really it makes no difference. But it's just a failure to understand what's happening there.
Correct. You have to be prepared for that. What are the fees? And honestly, if you can get them to look at the terms and conditions of a mutual fund and what they're really paying, it's criminal.
Well, and what person would be able to go to, they want to buy in a mutual fund, which one is going to be able to go to the owner of that corporation and ask them all kinds of detailed questions about, what are they going to do? Who are they going to hire? But you're able to do that with real estate. And that's the beauty of it. It's cash flowing day one, and you can have intimate knowledge of the deal. And that's what makes it so much more safer.
People running the mutual funds don't know.
Yeah.
They really have no idea.
Oh, I know. Yeah. They could do whatever. You could have anybody running that company. How do you approach, just another question, how do you approach the tax portion when first speaking with a new investor? And I'm assuming this is for the tax offsetter.
So I don't I make it clear that I'm not a CPA. This is just kind of what my CPA tells me. But I try not to get into it too deeply at the beginning, because if people are new to this type of investment, it really really throws up red flags. I'm telling you, it is just incredible what the tax benefits are on this thing. And I swear to God, I mean, I had to take my husband to 3 CPAs before he still thinks we're going to get audited. And I'm like, it's okay if we get audited because this is what we're doing.
Right. Yeah, and it's again like changing mindset, like you said. So with the tax thing, you don't want to change you can't change all mindsets in one day. So
Right.
You want to hit, okay, first, it's a cash flowing investment that pays more than 2.3%. So most of the time your minimum or your pref returns 8, and your cash on cash is 9, 10%. So or whatever the deal may be, as opposed to most of your stock options, which are up and down and all over the place. So changing that mindset to make them think that there's something outside of real estate. That's the first one. I mean, something outside of the stock market. And then the second one is the tax benefits. Because I think, like you were saying, if you hit them both at the same time, you can invest in real estate, which all financial advisors, I'll say all with quotation marks, will say, oh, real estate's is risky.
Oh yeah. Well, I wrote this article about just now. It's just out in Forbes Forbes thing about how my perception of risk has changed. Mm-hmm. And it's all about, some guy called me seriously and wanted me to invest in a movie. And he opened the conversation. I know you deal with real estate investors, so you got a lot of people that are willing to roll the dice. It's exactly what he said to me. And so I thought maybe you might want to you knew some people that might be interested in investing in this movie. And I'm like, oh my God.
Not a good way to start out an investment conversation. Like, I know people that like to roll the dice.
Well, I mean, it is, right? He's being honest that it is a dice rolling thing. And I sent it to a couple of people that I know do like to roll the dice. And if I had the kind of money that these people have, I would maybe do it too. It might be fun. But I go to the Academy Awards.
Discretionary funds. Discretionary. So we have another question that says, how do you find your lane if you are a new investor?
That's what you got to look at your assets. Look at what you've got. Look at those friends. Look at the family members. Look at what's important to you. Look at the experience that you've had. And everybody's had experiences. And if you don't, then you're not old enough to be, you know what I'm saying? I mean, you've got experiences. Yep. So you have to take the cards that God dealt you and look at what and that's where Coach Trevor honestly has helped me tremendously, is just here's what you've got, and here's how you can use them. And everybody knows people that knows people, and you have to know that's all about finding your lane. What kind of investor do you want to be, and what value can you bring to your circle?
Yep, exactly. Your circle is the one. Find what circle you're in, and then what circle does your circle touch, and then expand from there, I think.
Correct.
I had another one ask, will you be at Dealmaker Live in Dallas, Texas, the conference?
I don't think so. I'm going to be up in swim team world with my daughter upstate most of the summer. But
hey, that's great. Upstate New York, whereabouts?
Yeah, Woodstock.
Oh yeah, awesome. And isn't it the anniversary this year?
Oh, I guess I'm not going to be there.
Yeah, you're not going to be at the.
I promise you I won't be there, but I'll be in the vicinity.
Here's one. Do you have an outline of talking points you go over with new investors? How you go over the syndication process is great.
Yes. And what I do mostly, though, is I ask a lot of questions. What kind of investing are you doing now? There's a reason they're talking to me. Right. And so talk to me about what kind of investing that you do, what's your experience level. And then depending on what they say to those things, yes, I have some talking points.
Yep. Excellent. And in your current raising efforts, are you finding more investors want a preferred return versus straight GP-LP split? Depends on what they expect. Because you
Exactly.
have different group of investors for different types of property, and like there are some syndicators that have different GP splits, and their investors are used to that GP split, and some that take this kind of acquisition fee, and some that don't, and they're just used to that. So for the new investor, I don't think that they're not going to understand it at that level yet. If it's somebody that's already been investing, then they're going to stick with what they know and the terms that they are used to. Would you agree with that?
Oh, definitely. Definitely.
We have another one about the GP LP IRR and waterfall, which we went over that already, kind of the catch up there in the preferred return. And let's see, if all your investors left and you had to start over, what would you do to start building your investor pool over? That's an interesting question.
Well, I mean, in a lot of ways, I've done that with some of the thought leadership stuff that I've done, right? Some of the podcasts that I've listened to, and they've been wonderful enough to have me on there as a guest, and I've been able to share and just network. I mean, I would just do lots more of that, and try to add value wherever I can, and try to talk to a guy this morning, and I'm going to introduce him to 4 different people. My action items out of that, there's a number of things, but I've got action items, right, that I'm going to do. I'm going to send him this, I'm going to introduce him to these 2 people. So I've got like stuff I've got to do from this phone call I had, and he may invest, he may not. I haven't even said him anything about the investment.
Sure. And yeah, what you said there is provide value. So you don't ever want to come in trying to get value, because that sends up red flags. That's human nature. If I sense that you want something from me, I put up my guard, because everybody's skeptical, just like your husband, right?
Yeah, definitely.
So if they come in and realize that you're providing value, then they gain trust, and then they'll ask, and then that's where the relationship builds. You don't want to be selling something. You want to be providing value. What can I do for you? What can I do to help? And I think that's a good way to approach it.
Right.
This is a question I can answer. This one is California a good place to buy multi for an investor? And it's specifically for Southern California. And I think that we can all answer with a resounding answer that no, California is not a good place to invest in multifamily.
Unless you're buying for appreciation.
You've got regulations like crazy. You have, oh man, the sky's the limit. Your real estate values are out of this world. So no, I would not recommend it. There are a lot of real estate investors in California that invest outside of California. Now there are a select few that invest in California, but I don't know any myself that have properties in California.
I know a few people that flip houses and stuff like that, but
yep. But multifamily is tough, because remember, it's a rent. There are rent control laws in California.
New York's a disaster too.
As is New York now, thanks to your buddy Cuomo.
Oh, he's lovely, isn't he?
Yeah, I can get you started.
That's a whole other topic. I'm going to really get in trouble. Don't get me going. You're getting me riled up too early here.
Due to current multifamily market, due to the fact that the current multifamily market had been extremely competitive to find deals, would you consider looking into hotels, industrial buildings, or other CRE investments?
I don't know anything about them. Mm-hmm. I used to work with Marriott, and in my previous job is in advertising, and I know a little bit about how the business is, but nothing I would consider, but it would be a different lane.
Right. And that would be like if you had to start over, but multifamily is not going anywhere. It's cash flowing assets. So, it's kind of like what you mentioned before, not going all over the place. Because if you go into people like, hey, well, I got another deal for you. It's in this, it's in a movie, and then here's a hotel, and here's this. I think it's about specializing, because there are
storage and all that. I don't know.
Storage people invest in storage. Mobile home people invest in mobile homes, and multifamily people invest in multifamily. CRE invest in CRE. So I think that it's your lane thing comes down to it again. Mm-hmm. And knowing, because you got to know what you're investing in, and you can't know everything about everything. And so be really good at something, and
right.
really good at multifamily.
I work with good people, so there you go.
And we just had one more pop up. Are B-type properties in New York and Southern California under rent control?
Oh, that's a whole other. Don't get me. I mean, if you want to call me, I'll talk to you about rent control. I have all kinds of thoughts on it. I've been in New York for 30 years. I grew up in Texas where this didn't exist, and rent control is perpetuating poverty, and that's all I'll say.
Yeah.
All you're doing is they want you to. They don't want our schools to be good, and they don't want us to know this stuff. So,
Sure.
Yep. That's a whole other thing. So I don't know. I don't think it's a class thing as much as it is just historical.
Sure. Yep. Definitely. Well, great. That's all the questions that we've answered. We've answered all the questions, and got great comments here in the chat. And Holly, as always, a pleasure speaking with you. I can't wait till next time you're in South Carolina.
I can't either.
Grab. I always like to go to some different restaurant each time.
What was that we had at that restaurant? It was.
Oh, did you have the pig ears? Did you go to Husk with us?
No, it was some sort of a bread that we dipped in olive oil, but it was.
Oh, we went to Cafe and Grocery. Yeah, so that is just steka bread, which is a Turkish bread with the olive oil. Yeah, that's.
This guy knows. Wherever he is, I'll point. This guy knows what's going on.
If you're in South Carolina and want some food recommendations, I'll be glad. We're actually going out tonight, and so after we. Well, Holly, thanks again for being with us, and we look forward to talking to you soon. And thanks for sharing
everybody.
Everything you know.
All right. Bye-bye.
All right. Bye. All right, and I'm going to. All right. Thank you, Holly, again for that. We're going to have a break now coming up between 12:15 and 12:30, and then we'll be starting back up at 12:30 with why to invest in multifamily and how to get started with Tamara Marr. That's going to be in room 2. Room 1 is going to be a panel discussion. If you haven't seen one of the panel discussions, hop into room 1. They're going to be talking about raising capital, partners with Mark Kenny, Michael Blanc, Julie Lamb, Ryan McKenna, and John Fortes. So a great lineup there. That's going to be Dan Hamper's going to be moderating that. Room 3 is going to be alternate sources of capital with Peter Fisher. Danny Randazzo is going to be moderating in room 3. So join us again at 12:30. Don't forget to jump around, check out the different rooms, and ask questions, get involved. We're tracking participation for your entry and to win an iPad. And be sure to register your account in the Multifamily Investor Nation Forum for networking. And again, check us back out at 12:30. We'll see you then.